The technical definition is rising prices with falling production. In other words, you have a recession, an economic and activity recession,
Mhm.
and at the same time, you have rising prices. And so it creates this thing I call nominal confusion. The numbers confuse you because the numbers are going up, but the economy is shrinking. So I came up with this way of explaining it, and hopefully you guys can track with this.
Hi, this is Mike Maloney, and I'm with Russ Gray. Russ, how are you doing?
Good, buddy. How are you?
Good, good, good. So, we were talking earlier, and you said that we are going into a period now. There is an indicator that suggests that we're going into a certain type of economic environment. So, tell us all about that, if you could.
Well, I just saw an article up on Zero Hedge and probably in every major financial publication talking about the inverted yield curve. And, my buddy George Gammon, our mutual friend, has been saying for the longest time that the inverted yield curve has a 100% track record as far as predicting a recession. And so, but it's been inverted for a very, very long time. So the article said it just broke the record for how long it's been inverted. It's gone 625 days. And so that made me ask myself that, well, when was the last time that it went this long? And it turns out it was 1978. And I thought that was really interesting because there was another thing going on back in the 70s that we've heard talk about now, and that's stagflation. We haven't really heard the term stagflation. And so that kind of took me on a deeper dive. But, the inverted yield curve is like this indicator that a lot of macro geeks like to pay attention to because of its predictive quality. And some people are saying, well, this time is different. Other people are like, no, it's actually the same. It's just you got to go pretty far back to see when it was the same. So I just think it's worth paying attention to. And of course, I spend a lot of time trying to help people understand stagflation because not everybody has a benefit of being older like you and I. And they weren't around the last time there was stagflation. So it's a weird animal they've never heard of.
Yeah, well, that's inflation, but isn't it with high unemployment and lack of GDP growth? You just have inflation. We don't have high unemployment currently, but the way they measure employment now is very different than the way they used to measure the unemployment. Just give us the definition of stagflation.
So the technical definition is rising prices with falling production. In other words, you have a recession, an economic and activity recession,
Mhm.
and at the same time, you have rising prices. And so it creates this thing I call nominal confusion. The numbers confuse you because the numbers are going up, but the economy is shrinking. So I came up with this way of explaining it, and hopefully you guys can track with this. But if you had a business, let's say, that was manufacturing 1 million widgets a year at $10 a widget, you'd have $10 million in sales, right? So 1 million widgets times $10, you got a $10 million company. If you need 100 employees to manufacture those million widgets, you're manufacturing about 10,000 widgets per employee. And you're generating about $100,000 of sales per employee. So you say, okay, that's my number. Now, let's say that inflation causes your pricing to go up, and it goes up from $10 to $12. And when you go from $10 to $12, you lose about 10% of your customers that are at the margin. They can't afford $12. They're willing to pay 10, but they can't pay 12. So your sales drop from 1 million down to 900,000. Well, if you do the math, 900,000 times 12, your company is doing $10.8 million in sales. So nominally, by the numbers, you have 8% growth. But in terms of actual productivity, you're 10% down. You're only producing 900,000 widgets. So the economy gets 900,000, or they get $100,000 less of real goods. That's one problem. Second problem is if you only need 10,000 employees or 10,000 widgets per employee and you're only producing 900,000, guess what you don't need? You don't need 10% of your workforce. So you lay off 10% of your workforce. So you, as a contributor to the economy, are decreasing the number of jobs and you're decreasing the amount of product. And yet both your sales and your profits are up because of inflation. So nominally, you look like you're growing. But in terms of what matters in the real world to real people, the goods and services and jobs, it's going down. Well, the problem is when you have less goods and services, you're going to have potentially less supply, and then that in itself starts to become inflationary. So it starts a chain of events. It's very difficult for the average person to recognize, but really causes problems for investors because they think they're getting growth when in fact they're not.
Right. And even though you're doing 10.8 million now, or what was the number?
10.8 million, 900,000 widgets at $12 is 10.8. Right. So you're 8% up.
Yeah, you're 8% up, but prices may have gone up 12% or whatever. So that 10.8 million is not the same 10.8 million, and you're produced. So you're actually making less.
You're making less. Real wages buy less. Yeah.
Less employment. Yeah. So unemployment rises. GDP doesn't necessarily have to fall. It can just stagnate and go sideways while all of this other stuff is happening. Prices going up. That is a very, very interesting analysis showing the reduction of actual products of goods and services and the layoff of the labor force, while the numbers are actually, it's painting a rosy number. It's putting lipstick on a pig, isn't it?
It's very, very confusing. And so as an investor, as a business person, as a politician, you're trying to make policy decisions, you're trying to make investment decisions, you're trying to make strategic decisions about expanding your business, and you're deceived. Now, there's other things that add to that problem because all of a sudden you're making less real money, but you're paying higher taxes. And the components of cost are higher. The purchasing power in the marketplace, inflation in this example is 20%. You went from $10 to $12, but your company only grew by 8%. So even though you had nominal growth, you fell behind to inflation. And this is why stagflation is such a difficult thing to invest. And I just feel like as an older guy now, having lived through it the first time, there's so many investors out there, business people right now, even policymakers who really don't understand what inflation is and why it's such a problem. And so I thought it was super interesting to see that this inverted yield curve has not resulted in the 100% track record of a recession yet. But the only time that it took this long was when we had stagflation, because it delays, potentially, it hides or it covers up what has actually happened. I mean, you can make the argument in hindsight that we are in recession, but not by the numbers, but by the jobs. And again, I agree with you. I'm not so sure, since we've got, I think 13 of the last 15 jobs reports have been revised downward. Like, how much stock do you really put in those numbers? I don't know. Not much.
Right. Yeah. I think that the longer this goes on too, the more energy sort of gets stored up, and the worse this recession that's coming, if we're not already in it, is going to be. I really think that I just get the feeling, especially after writing my book, when I was doing a deep dive into all of the data at once, and I had to look at this stuff over and over and over again and write about it, all this Federal Reserve data, I really became quite anxious, quite scared for what is going to happen in the economy, because these things always have to balance themselves out. And when, also, a lot of people say that the quantity theory of money is incorrect and it doesn't apply, but they increase the quantity of currency and they reduce the interest rates to pump things up, but then they increase the quantity of currency dramatically during the pandemic. And then they raised interest rates to try and stop inflation, like they're going to get a hold of this Frankenstein monster that they created. But this can't happen with real money. If we use gold and silver, you can't increase the currency supply by that amount in that short a time. And everything with hard money, you end up with these short-term inflations and deflations that are all caused by velocity, but it all nets out to zero as long as you've got about the same amount of currency units per person. It all irons itself out. It's self-balancing. But they think that they can stop inflation, but it won't stop until the quantity that they've created gets accounted for.
Well, I think, Mike, you said something that was very insightful, and I want to make sure people don't miss it. And that is this stored up energy and the intensity of what I call a snap back to the trend line. You didn't say it exactly that way, but that's essentially what you were saying. When it corrects, when it comes back, when it goes back to equilibrium, when the natural order of things is reestablished, the reality check comes due, if you will. That's when it gets really tough. And that's when a long-term trend becomes an event and slaps everybody upside the head. And of course, folks like you and me and people like Peter Schiff, Robert Kiyosaki, people that understand kind of the underlying trend and the structure underneath what's happening, realize that we don't know when it's going to break, but we know that it's inevitable at some point it will. And I'll give you an example because this is really interesting. I mentioned this before we hit the record button. And that is this idea, because we've seen it with inflation, right? If you remember, Janet Yellen just came out and she publicly apologized, or at least admitted she regretted using the word transitory. She had egg on her face. She goes, I said inflation was transitory. I regret using that term. And it was kind of a weak apology. And I've let other people go look it up. And because she wasn't really admitting she was wrong. She was just saying, I used a term that confused everybody because what I meant, you guys were too naive or ignorant to understand. I think that's crap. I think that they just flat got it wrong, but whatever. Anyway, so inflation wasn't transitory, but I think to put it in Main Street language, and of course I'm very fortunate that I kind of speak Main Street and I speak macro. I try to interpret for people. If you were to go buy an apartment building, and you knew that 20 years from now, that roof was going to need to be replaced, and it was an extremely expensive repair. And every month, you should be setting aside some from your net operating income in a reserve account that one day is going to deal with this roof that needs to be repaired. But you decide not to do it because it gooses your returns. Right? You don't put up. It's like what we've done with Social Security. We pretend like the money's there, but really we just been borrowing it and have a bunch of IOUs in there. It's not really there. And of course, now they're talking about how Social Security is going to be broke. We've got the demographic problem. Global population for the first time in 700 years is declining. That news just came out. Now the Republicans are coming out. Hey, we need to extend the age of Social Security again, kick the can a little bit further down the road. But
as a real estate guy, you call this deferred maintenance, correct?
It's deferred maintenance. It's deferred maintenance. And so I have an article from CNN, October 29th, 1999. And in that article, what Alan Greenspan basically says, says the dollar's changed very little against the yen and higher against the euro. Speaking Thursday evening, and this is October 29th, 1999, Greenspan said that, technology gains technology gains have helped boost U.S. productivity and kept inflation in check. He said the same thing again in January 13th, 2000. He talked to the Economic Club of New York. I got a copy of this too. And he says the same thing. He says the American economy was experiencing a once in a century acceleration of innovation, which propelled forward productivity, output, corporate profits, and stock prices at a price not seen in generations. Okay, if you really think about what he's saying is that business people doing what business people do are innovating. They're applying technology. They're finding better processes, and they're driving costs down. But inflation is driving costs up. So there's this tug of war between Main Street productivity and Wall Street or Fed inflation, and they're balancing each other out. However, all of those profits, all of those gains that should have been invested in the economy, which would be yielding gains 5, 10, 20, 30 years down the road, those investments were never made. Just like that deferred maintenance on that apartment building, that money was never set aside. So my prediction in 2021,
not only that, but those profits were basically stolen. They
were stolen. They were 100% stolen by inflation. Keynes said inflation is how the government steals from the people, and not one man in a million can diagnose it. Well, fortunately, we have shows like this, and more people are able to diagnose it. And the clues are right there in the news. Greenspan was admitting we are stealing the productivity gains. And they're once in a lifetime. There's a bell curve of what humanity experienced. There was this huge gain in productivity, and then it tapered off. But the loss, the inflation kept going. And so they were dealing with it, in a lot of different ways. But my prediction was that when that whale of inflation, its nose comes out the top of the water, it's not just coming out, it's going to go shooting through the air. And that's exactly what happened. Last 3 years, we've had 20%
and when
inflation.
It comes crashing down and splashes into the ocean, you just don't want to be swimming right under it.
That's it. They're going to have a very difficult time handling this because of the size of the Fed's balance sheet, how much money they put into circulation, how much debt there is in the system, and how out of position productivity is to be able to keep up, right? It's supply, demand, and capacity to pay. And we've got a supply problem right now, a supply chain problem. You can blame it on whatever they want. But at the end of the day, our economy is not producing enough. It's not productive enough for the amount of money sloshing around in the system. And that means inflation.
Yes. Yellen said that inflation was transitory, and that is wrong. Inflation is always permanent unless it is offset by a deflation. A change in the inflation rate can be transitory. But inflation, once inflation takes off and prices rise, they don't come back down. If the inflation rate goes to zero, they plateau at that new higher level. So your cost of living has increased, and until your wages increase, which is inflationary because whatever product or service the company that you're working for is making, if they pay everybody higher wages, then they've got to raise the cost of their product, and it's this vicious spiral. And now you're talking about stagflation, masking the effects of this so that it makes the numbers look rosy, even though it's a total train wreck.
Correct. Right? And it shows up. That's why you have to measure what's real. If you just count everything in currency, like if you count your net worth by the price of gold, you're missing the whole point. You count it by the number of ounces. Doesn't matter what the dollar price is. It really doesn't. If you have 5 ounces of gold at $2,000, or you have 5 ounces of gold at $100,000, you have 5 ounces of gold. If I have a 3-bedroom, 2-bath house at $50,000 or at $250,000, I can still only sleep 3 people. See, if you measure your wealth in what's real, then all of this nominal confusion is less likely to get on you. As a real estate investor, the idea is, hey, the tenants are going to pay somewhere around 25 to 30% of their productivity, their income, to live in the property. It doesn't matter whether it's denominated in gold, silver, puka shells, yen, yuan, dollars, central bank digital currency. It doesn't matter. It means that somebody's going to get up, a human being is going to get up and do real work. And they're going to pay me 25 to 30% of the value of that real work to live in the property. So I just want to have a lot of properties that I can rent out. I want to have a lot of ounces of gold, and whatever the currency is, it's what the currency is. And I think the sooner people start to get out of the business of trying to think exclusively in the dollar, when the dollar's value is so volatile and perverted, we avoid these types of, I guess, sleight of hand that the policymakers are able to do.
Excellent. Well, I want to thank you so much for this quick lesson on economics and stagflation, because I think this is going to be enlightening for many people. And I actually hadn't gone through the actual numbers, the nominal figures like you have, showing how stagflation is like trying to drive through a fog. So
yeah, and I just want to encourage everybody, guys. You don't have to have a PhD in economics. This is really just common sense. If you just sit down and break it down to very simple principles, right? You can begin to understand. I think the people in charge try to make it a whole lot more complicated, using terms like quantitative easing and all these terms, and just trying to confuse a Main Streeter to make you think these people are smarter than you are. Most Main Street people have enough common sense to understand these concepts if they just understand the fundamentals. And I think the quicker you think in terms of what's real, the better off you'll be able to make decisions and really accumulate what's going to be truly valuable, no matter how badly they screw up the system.
Well, thanks a lot, Russ. That was absolutely fascinating. I thank you for your insights. And I want to encourage everybody to visit. Where can they follow you, Russ? It says right.
They can just send an email to follow@russellgray.com. I'm in the process of actually reorganizing my media life, and I'm going to be putting together a new channel to be talking about gold and real estate and real wealth. I'm excited about it, kind of tying in with the book that I'm writing. I feel like right now the world just doesn't understand how gold, real estate, and debt all work together. And I think the only way to survive in an environment where this type of inflation is baked into the cake, they cannot escape it. You got to have gold. I think you got to have real estate, and you got to have debt. And learning how to put those three together and do it well, that's what I'm really focused on right now. So it's really fun to be able to come and visit with you every so often, Mike. I appreciate the invitation. I really appreciate your audience and the kind words that I see in some of the comments. So if anybody has any questions, just send an email to follow@russellgray.com, and maybe next time I'm on, I can address some of those too.
Okay, excellent. Thank you very much. And we'll see everybody next time. Thanks for watching.